Hey everybody, welcome to this free edition of our Trader User Group Weekly Roundup. This is for the trading week ending October 2nd, 2020. I'm Preston Brent. Thanks for tuning in. Remember, don't be a rat brain trader. You want to be the red striped zebra. And this week's theme is on a razor's edge. Well, let's take a look at the markets and just kind of see where we are right now as we got one more quarter left in this trading year. If we look at this past week, you're going to be able to see that just about everything in the U.S. was in the green. Year to date, we've got the S&P and Nasdaq in the green. The Dow is down 3%. Russell actually had the best performance this week, up 4.37%. Year to date, the rut is down about 7.74%. Now you can see valuations and volatility on the right-hand side. The forward PE ratio is at 24.82, so it's lower by about almost 33% from the trailing. So there is a discount there, but it's still very high at 24.82. But we would expect that because you can see the 10-year Treasury yield finished the week at 69.6 basis points. So still very low interest rate wise. The dividend yield coming in at 1.81% for the S&P. So that gives us a positive spread, the S&P over the 10-year Treasury by 1.114%. So that still channels money into the equity markets. And you can see the VIX. Actually, this is the second week in a row that the VIX is slightly skewed up just a little bit. It's up about 4.7% for the week. The VIX closed at 27.63 for the week. If we look at the weekly sector performance, you can see the best performing sector in a rare show of strength was the financials, coming in the week at 3.66. The worst 2 weeks in a row, energy down 2.67. And then year to date, you can see energy is just horrible for the year. With one more quarter left, energy is down 48.62%. Technology is leading the way to the upside, as we would expect, at 26.67%. And then if we look at the world index, we can see just about everything finished in the green this past week, with the exception of China coming in about flat. But China is the only world index that's in the green year to date. So there's really only 3 indexes in the green year to date. 2 of them are in the U.S. with the S&P and Nasdaq, and then 1 is the Shanghai index in China. Otherwise, you can see the FTSE over in London. It's still in bear market territory at 21.75%, with the Brexit giving them a hard time as they try and figure out some solution to Brexit before the end of this month. Otherwise, there could be a hard Brexit, as if there's not enough to worry about. The CAC 40 is down just slightly under bear market territory. DAX and Nikkei, just slightly in the red. And then Hang Seng, the Hong Kong index, is down about 16.78% with all the problems over in Hong Kong. So we still are seeing worldwide relatively poor performance by most indexes. Now, if we take a look at the weekly sound bites for the week, kind of see how the thing is. Let's take Q3 just came to an end. And as we saw, this was the weakest September in almost 10 years, all right? In fact, September was a very weak month, but it did not equate to a weak quarter. Q3 finished up about 8.5% for the quarter. The Dow was up about 7.6. And then we had a very strong Q3 was followed by a strong Q2, right? I mean, Q2 was also very strong, with the markets hitting lows in March 23rd. So we've had the best 2-quarter performance back to back since 2009, okay, as we bounced hard off the March 23rd lows. Most indexes are up over 25%. The Nasdaq is up 11% in Q3, and for the 6 months, Nasdaq's up 45% for 2 quarters. Really, really strong. Q3 GDP estimates are really starting to arrive in the coming week. We're seeing the U.S. economy is expected to post an annual growth rate of about 30%. Really kind of driven by strong consumer spending and stable income levels based on the stimulus that we're seeing so far. All right. Now, this past week, as I just mentioned in the prior slide, we're up mostly for this past week. So that ends 4 straight weekly declines. Okay, the political environment kind of played a large role driving sentiment this week. Most investors are watching the conflicting signals on whether we're going to have fiscal stimulus or not. As Mnuchin and Pelosi battle it out on just if or how they could cobble together a fiscal stimulus package. Also, Thursday night, Trump's announcement that he and his wife contracted COVID added more uncertainty as we finished out the week, although we did manage to have, finish in the green mostly. Nasdaq, or I'm sorry, the Russell finishing the best. The small cap had a strong week. Now, the other thing that I wanted to talk about is the jobs data mostly. We saw monthly payrolls data this past Friday come in at 661,000 jobs added. It was kind of below consistent estimates of about 153,000. But employment did come in at 7.9%, right? We did see weekly jobless claims on Thursday um, um, post-pandemic low of 837,000. So although we are getting news from the airlines that unless we get this fiscal stimulus, if Mnuchin and Pelosi can't work something out, airlines are talking about laying off another 32,000. So that is going to be, we'll know that this coming week, all right, as we get into the first full week of October. Now, interest rates, what we're seeing there, both intermediate and long-term treasury yields moved up just a little bit this past week, kind of driven by renewed hopes of a stimulus deal. If that stimulus deal happens, you will see interest rates move up a little bit, okay? And you'll see the markets bound higher as well. The 10-year, as I said, finished the week at 69.6 basis points. That's up just a little bit from the prior week. And also the credit spreads between investment grade corporate bonds and junk narrowed or tightened a little bit, which is still a good sign. It shows there's a ton of money out in the market, but of course we all know that. And the only other market really in the green besides the US year to date, the China market, Shanghai, their stocks came in just slightly in the red this week, but they're getting some for the month of September as they round out Q3. They've got pretty good, strong economic readings. That their recovery is, coming in pretty much on track. Their PMI data is all over 50, showing economic expansion. So, hopefully that'll be a sign of things to come across the European markets and the U.S. markets. Now, we're really 1 month away from what I think is going to be one of the most emotionally charged and really uncertain presidential elections that I can remember. And we're going back probably in U.S. history. It's going to be really wild, almost like we should go back to the old French times and have a sword duel or a gunfight or something like that, because that's what it seems like. But what does this all mean for equity markets? Well, this uncertain nature, of the voting process and perhaps the results of that have a lot of traders, me included, thinking the market is just going to be a lot more volatile. And if you guys will recall, as I mentioned just about every Sunday now for the past month, we had a 4-week wait between the Bush and Gore election before it was determined, all the way up to the Supreme Court, of course. Bush won, but during that 3 or 4 week wait, the S&P dropped over 6%. So can we get a repeat of that? Well, that's why we're seeing volatility drift higher as we move through this. So this next month's election is going to bring us more of the same, but I think volatility is already being bid up right now because the markets already know what happened in Bush Gore with vol up 6%. And it was a sudden shock back then, but they're being bid up now. Vol markets or volatility is being bid up. So we could have one of those kind of scenarios where there's a clear election winner and volatility drops really hard after the election. But I believe no matter what happens, it's going to be contested, no matter how big the winner comes in. So, folks, we need to be ready for just about anything, right? I mean, that's just pretty much what I'm seeing. Now, let me just switch the screen over here, and I'm going to take you over to a couple of things that have my attention that I'm following here as we go into the month before the election. The one thing I want to look at, and let me just switch the screen here. It'll take a second or so to paint on your window there. But I'm looking at the volatility, and I'm also looking at technology, because technology, as you guys have seen, has driven markets higher and lower, because it's about 23, 24% of the market cap of the S&P, and that's just the 5 stocks that make up the special index that I've created here in eSignal. On this index here, I'm tracking Microsoft, Facebook, Apple, Netflix, Google, and Amazon. And you can see this huge drop that really we made the all-time high for this, I guess you could call it a modified FANG index on September the 2nd. And then for the entire month of September, we've just come down. And these are profit taking. And if I step out, you can see this trend line right here. And if I really step it out, again, this is a daily chart. You can see here how we've just run nicely coming back to the summer months almost a year ago, this trend line. And the tech sector has just done very well. Ever since this hard bounce in March 23rd, we really didn't even break this. This is a daily chart. So all we did was hit the bottom of the channel, and then we just had this huge enormous run to the upside, and you can see that upsloping channel there. We finally broke it on September the 10th, and now we're coming back down, and now you can see here as I zoom in, we're sitting literally right on the 50 EMA. That's that red line that I've got highlighted right there. So I blow it up, you can see the 50 EMA. There's the top portion of that upsloping trend line. So it'll be very easy for this market to just give it up and come back down, test this low that was made on September 21st, and come down and get back inside this line again. So I think if we get a fiscal stimulus package, you're going to see us take out this R1 level right here, and it's going to move back up and probably retest this upsloping trend line. That would be very bullish for the equity markets. And of course, if we look at the E-minis, the S&P 500 futures, you can see here that just looking at the fib nodes, you can see we briefly crossed below the opening or the closing price of 2019. So we were in the red really for just one day, and then we immediately bounce back out. We're above the 50 EMA right here. So we're kind of at a touch point here. Remember, everybody wants to know, is this a bull trap? This little move right here coming back up, is this a bull trap? Or are we going to continue to move higher? Well, unless we can take out this little resistance zone right here, then I would expect to move up, back down. The 50 EMA is running flat. The 200 EMA over time is going to start to run flat. We have railroad tracks, and then we could come back down, test the 50 EMA. If we fall inside it, we're going to just run sideways until we get through the election. And then the election is going to give us the next directional bias, okay? If we do break this level right here, we're going to run higher. Now, if we get a fiscal stimulus, and it's a good one, I think we're going to break this, come up. We may retest it, of course, but then we're going to trade in an upper boundary set right here versus down in this area here. So remember, the market's going to move up, pull back, move up, pull back, and I'm looking for key pivot points, and are we going to take them out or not? And then once we get into a key pivot point, we tend to trade in a range for a while, and I want to see that pivot zone or that field of play is going to hold up or not. For our members, we'll go into more detail on this, but there's just, we're having a really good year this year in some of the trades that we're doing and some of the ways that we're deploying option strategies. You can also see I got the fib node on here. We're above the 23.6% fib node. So this would indicate that it's going to be tough sledding to get back up over the 3,400 level, which is kind of a psychological barrier, unless we get that fiscal stimulus. If we do not get that, then we've also got the issue with Trump at Walter Reed. So we got to watch that very closely. So we've got a number of binary events that could come up that can change the polarity of this market very quickly. All right. So that's a little bit about what I'm seeing right now. And of course, let's come down and look at volatility and spend a little bit of time on this for a minute. You can see the VIX. It really moved up on Friday. We closed, we closed higher because of the news with Trump because we gapped down and then we just kind of or we gapped up and we pulled back just a little bit, but it's still elevated. All right. You can see the MACD crossing above the zero line, which would indicate we've got some higher volatility to come. We're still in this zone right here. Excuse me. And this zone right here would indicate that it's going to stay elevated. Once we went into the black swan zone up here, it's all dark. I had said we're going to stay elevated through the end of the year, and that's exactly what's happening. It's kind of the same way vol played out in 08 and 09. We stayed over 30 for quite some time, okay? And we could do the same thing here. But let's really dive in a little bit deeper. Let's go look at the front month skew. The front month skew is in the green. So that indicates the markets are still not that concerned right now. And it's vol has just very slowly been jacked up with not only the front month volatility futures, but also VIX. So it's kept the skew really in contango, not backwardation. So that's a normalized skew, even though the entire skew curve has shifted higher. And if we look at the back month vol futures only, which is the October, November, you can see we're well enconced in the green. Now they're elevated for sure, but the skew between October and November are in the green. All right. So we've got that scenario. And if we look at the October vol futures just by themselves, you can see where we're sitting. And then let's go to November. If we look at November, you can see the November volatility futures are sitting at 32.95. So 32.95, right? Now the VIX closed at 27.63. So we've got about a 5-point difference between November and the front month VIX. That's a pretty wide range there. And if we look at the Vixen, which is a constant 90-day view of vol, you can see it's pretty high, right? I mean, it's up at 36. Now, if we look at November, we'll go out even further, and we look at the November, not the October, November, we're at 32.95. And then if we go over to December, notice December, it's back down to 31.55. All right. So December is actually less than November. So vol is being jacked up in November. Why? Because of the election. All right. So we've got between November and December, we are in a backwardation. So it's rare that you see a contango term structure out about 3 months and then it shifts to a backwardation, and that's only because of the election. So just make sure you guys understand what the volatility market is essentially telling you. It's telling you to expect volatility in November and December. Okay, that's what it's telling you. Now, we probably fundamentally know that. But if you're buying or selling puts that far out in time, they're bid up right now. Okay, the out of the money puts are bid up in the November series. And then if you look at January, vol comes down again to 30.55. So the bid up period is November. So doing a November December calendar spread or a November January calendar spread kind of makes some sense, right? Because you're selling the higher vol and then you're buying the lower vol. So these are just some things, members, we'll kind of review here, but you want to take advantage of some of these skews that we're seeing here just because of this binary event. Now remember, if the election's contested and it drags out in time, this volatility can go a lot higher. Okay, I think it's bid up higher than it was for Bush and Gore, so it kind of surprised the markets. But right here, we're elevated a good deal. If it is a landslide, you'll see this volatility come down hard, and it'll be a vol crush. Okay, so it will be an interesting event coming up, and we want to pay attention to it. Of course, if we look at treasuries, look at the bond market, we're kind of staying in this range. I do believe if they get that fiscal stimulus, bonds are going to go lower. We're probably going to start to trade now in a lower range. So doing that kind of trade here to the downside, to me, in bonds makes more sense. Okay. And then same thing with TLT. All right, TLT's been in this range here. I'd do an out of the money fly or a skewed iron condor or something like that, trading it more to the downside, which means interest rates can scope up just a little bit. Of course, if we look at the US dollar, it's performing well or better, but I think longer term, I got a target of the dollar down around 91, roughly 91.1, something like that. Right? So we've had this 3-leg, 4-leg. This 4-leg will probably be drawn out. You can see we're sitting just slightly under the 50 EMA. You can see that red line there. Now remember, the US dollar is not the US dollar, it's the dollar index. And the dollar index tracks the euro, which is 57.6% of the dollar index, the yen, which is about 13.6%, the pound, 11.9, Canadian dollar, and then you got the Swiss krona or the Swedish krona, and then the Swiss franc. So the euro and the yen make up a good piece of it. The euro and the pound, which you kind of lock together, is about 59, almost 60%. I'm sorry, 70% of the dollar index, right? I mean, it's huge. So the dollar is going to go opposite of where those guys go. I think longer term, the dollar is going to go lower. Shorter term or longer term, the euro is going to go higher. All right. So doing some put credit spreads, bull put spreads underneath the euro makes sense to me in the futures market. All right. If we look at metals, let's look at gold. Gold is coming down. It's coming down to my level here. I had said it's gonna probably take out 1900, come back down, maybe test these lows here. Eventually, the dollar's gonna, the gold is gonna go higher. I still like, believe it or not, silver better than gold. On a relative performance basis, we've done really well trading silver over gold, and you can see this move, that we've made so far on this chart. Really a nice move. So, but I said this right here would be the support for silver. We came right down, kissed it, and we bounced right back up. I think we're going to run sideways for a bit. All right, we're going to run sideways until we get this thing figured out. Oil, well, oil markets are really in a funk. We're coming down to my support area here. This is my hard support right here. You can see we're just touching it and kissing it right now. I think this will hold. It should hold. You can see if we go back, we've tested it numerous times. If they get that stimulus, that'll be bullish for oil. Okay. Do not use USO. I think that ETF is broken. All right. There's other ways to trade oil. And by the way, if you just wanted to buy Exxon Mobil, all right, let's go take a look at the charts because it sucks. But look at this. We're down at lows that to me, it's a buy down here. It's got, like, at this rate, the dividend is about 11 or 12%. So they're not going to declare bankruptcy, all right? Not Exxon Mobil. I mean, you never say never. This thing could always go lower, but you can sell calls against it if you need to. But just picking it up, as part of your dividend portfolio for those of you that are looking for some income, that to me is I think a pretty good solid bet. Nat gas, well, nat gas did that spike up. And remember what I said, after it's coming back down, I was waiting for a higher high, which it did do. But I just did not take the trade, right? But it kind of did what I had indicated to you guys. I said it should do a higher high. We came all the way down here. That's a very extenuating C leg right there. So to me, I think there's more downside in nat gas than upside, right? That's just net where we're sitting. Now, there's a lot of other things floating around in the market. I will go through that with our members this Sunday evening. If you're not a member of our group, I encourage you to come in. We got a lot of great things going on. We're going to finish a really good year this year, even including the wipeout in March. We saw that thing coming probably about the third week in February, all right, with some of the things that we're looking at. All right, everybody, have a great weekend. Members, I will see you Sunday evening for our weekly market watch. Everybody else, see you next weekend for the next free weekly roundup. Take care, folks. Ciao now.